Hey guys, it's Glenn. Hope you're doing well. Hey, just wanted to share with you a story about an HVAC guy I met with recently. His name is Mike. Mike's 45 years old. He's an owner operator, been in the trade for a long time, runs multiple trucks, solid reputation, busy most of the year. One week, right in the middle of peak season, one of his service trucks went down and had to be fixed immediately. Mike had the money to cover it, but some of the money was earmarked for payroll. Some of it was waiting on invoices to clear, and some of it was sitting in accounts he couldn't touch without paying penalties and lots of taxes. A few days later, he was talking to another friend of his who's also into HVAC, and Mike was talking about how annoying it is that every time something expensive popped up, it turned into a scramble. That's when the other guy said he used to deal with the same thing. And that's why he started keeping a portion of his money in a life insurance policy that he could access when stuff like this came up. And Mike was like, "What do you mean?" Because he had never thought of life insurance that way. To him, life insurance was something you had just in case something bad happened, not something you actually used while you were alive. So he started asking questions. And what he learned was simple. The money could sit inside a permanent policy designed to grow tax-free and still be accessible whenever he needed it. So he reached out to me and told me exactly what he wanted. And that's what we built. Alright, so let me show you exactly what this looks like. What you're looking at is the plan we set up for Mike. We designed this as a 5-year funding plan. Mike didn't want to do anything aggressive. He chose to put in $25,000 a year because that was money he was already setting aside during the strong months without putting pressure on payroll or stressing the business. To him, that meant having cash he could reach when a truck went down or equipment needed to be replaced, not having to reshuffle accounts or delay other obligations, not leaning on credit cards or short-term debt just to keep things moving. And it also meant that if work slowed down or something unexpected hit, everything wouldn't immediately tighten up at home or in the business. Longer term, it meant building something outside of the trucks and day-to-day operations, something that would still be there even if he decided to step back from the field. So from age 45 to 50, he's funding it at $25,000 a year. Over 5 years, that's a total of $125,000. Now when you look at an illustration like this, there are only a few things that you really need to pay attention to. Let's look at the far right 3 columns. Okay? First, there's cash value. That's the money inside the policy that's actually earning interest. When he puts money in, there's cost early on, and then the rest of that money flows into the cash value bucket where it grows over time. The next column is the cash surrender value. This is the important one. This is how much money Mike can actually access. Think of this as his available balance. This is the money he can use if a truck breaks down, equipment needs to be replaced, the business hits a slow patch, or something expensive shows up out of the blue, or even if he's diagnosed with critical, chronic, or terminal illness. This is the portion of the money that's available tax-free. No penalties, no age restrictions, and again, tax-free. This was a big deal for him because unlike traditional retirement accounts, this money isn't locked up. You'll also see a projected rate. This isn't a guarantee. It's just a projection based on how the policy is designed and historical performance. We're not assuming anything crazy here, just steady growth over time without market risk. So when you zoom out and look at this after 5 years, here's the simple picture. Mike put in $125,000, and now he has a pool of money that is growing, is accessible, and isn't already tied up inside of the business. So instead of everything being trapped in checking accounts, equipment, or timing issues, he now has a place where money can sit, grow, and be ready when the business needs it. Now here's the part that really mattered to him. After age 50, he stops putting money in. Nothing else goes in it. He just lets it sit there and do what it's designed to do. When we fast forward to age 65, there's a meaningful amount of money sitting there. Not just as a number on a page, but flexibility. options. Mike now has options. He liked knowing that if he wanted to slow down, step back from the field, or stop climbing around in attics every day, he had something to lean on. Then we looked at age 70. Same story. The money is still there. It's still growing, and he still has access to it. For the first time, retirement didn't feel like an all or nothing decision. It wasn't about shutting the business down. It was about having options. And that's what this plan gave him. Hey, so if you're watching this and you want to see what something like this could look like for you, based on how your business actually works and how you make money, I'm happy to walk through it with you. You can schedule a call using the link below or just send me a message.